Today, the Fed announced a pause in their Fed funds rate hike. This is the first pause that they have announced since they started raising rates a little bit over a year ago. The analysts are calling this kind of a hawkish pause. It means that we're really looking for future interest rate increases. And you would think that if they've been raising rates for a year and then they pause, that maybe we could start to see them going down. But it really was the Fed chair's comments after the announcement that they were going to pause rates for this meeting that really made people think that there's more coming. People expect a couple of more increases throughout the end of this year, and then significant decreases as we go into the following year. Right now, what we're seeing, when you look at the 10-year Treasuries, the yields on the shorter term are higher than the yields on the longer term. And basically that is what they call an inverted yield curve. Usually to borrow longer term, you have to pay a little bit more interest because lenders are committing to you for a long period of time. And they need to hedge that commitment in case their cost of money goes up in the meantime. And so typically you're going to see a higher rate. When investors expect rates to come down, that yield curve gets inverted. Higher, shorter term, longer, lower, longer term, and you're seeing that right now, on the Treasury yields right now. And the other thing that's relevant about that is there has never been a time in history when an inverted yield curve has not predicted a recession. That's just the facts. That's just the reality, and that's that's not news to most people. Most people have been expecting that. Is it going to be a hard one? Is it going to be a soft landing? There's a lot of room for debate on that, but I think virtually everyone agrees that is the case, and the Fed's kind of counting on that. They're kind of counting on that to slow down the inflation rate. That's what this was all about all along. They can't afford for the inflation rate to get out of hand. And the other element of that is, yesterday consumer price numbers came out. The consumer price index comes out monthly. That's one of the most closely watched inflation indices. And it shows inflation cooling, but not fast enough. And I think that's part of the reason why the Fed is sort of hedging their bets and stating that, yes, we're pausing now, but that doesn't mean we're stopping. That doesn't mean it's over. And so inflation numbers, but the other thing too is the job market's still pretty hot. Jobs are still being created. The rate of increase of wages has slowed down, and that's going to be somewhat encouraging to the Fed. But as long as the number of jobs, job creation numbers, unemployment numbers are such that the Fed feels like there's a risk of undersupply of laborers in the market, which gives them tremendous pricing power, which creates inflationary pressures in the economy. I think that's one of the reasons why they're keeping the future increases on the table for now. So as long as the jobs market starts to decline, or at least shows a little more weakness than it has shown, or continues on that trajectory, we might see the Fed kind of back away from that and start to project that this is going to be over, and we're going to start to see the interest rates kind of bottom out. And then if we did go into a recession, then you might start to see them lower that. Now, how does that translate into mortgages? Well, that's a very deep and detailed conversation beyond my expertise. But one of the things you do see is there's a typical spread between the 10-year Treasury and the 30-year mortgage rate. And that typical spread, I think it runs between 1.5, to 2 points, is a typical spread. And what we're seeing now is 1.75 or 2.75 to 3.25 points spread, which means that if the 10-year Treasury yield is 3.5, then the 30-year mortgage is 6.75. Now, normally, if we had normal spreads, that 30-year fixed rate would be a point or more lower than what we're seeing now. Now, what has caused this increased spread? Well, there's several things that have caused this increased spread. One of the things is just volatility. This is a very volatile market with, traders are very sensitive to what's the latest Fed's interpretation of the data. Is inflation rising? Is it cooling? Are jobs too strong? Are they weak? Is the housing market? And so we've seen a very volatile, and then throw into that, we had the debt ceiling issue that was going on, and it creates a lot of volatility. It means the market is very reactive to whatever the latest news is. And that makes it very expensive for lenders to hedge their loans. When they offer to lend you a 30-year fixed rate and they lock it in for 30 days, they can't deliver that loan to Fannie and Freddie for 15 days after they close it or 30 days after they close it. And that period of time is the time that they're risking They've fixed their price 30 days before closing, but they're not delivering that for sale into the market until maybe 45 days after they locked you in. And the market could be vastly different, so they have to hedge that. They pay somebody else to absorb that risk, so they're not absorbing all of that risk. And that cost goes up in a volatile market. That's just the nature of things. When things are volatile, the cost of hedging is greater because the potential risk is greater. The other thing, there's economic uncertainty also increases the premium. You know, when you are lending, when you're buying a 10-year treasury, you're lending directly to the U.S. government. And the U.S. government, recent events notwithstanding, has never defaulted on their debts. And so that loan to the U.S. government in the form of a treasury bond is considered almost risk-free. And so anything that is outside of the U.S. government has some element of risk. So mortgages are financed by mortgage-backed securities. They're issued by Fannie and Freddie. They're backed by mortgages. And they're implicitly guaranteed, but not explicitly by the federal government. And so there is an element of risk there beyond what is present when you borrow in a 10-year treasury from the U.S. government, or you lend to the U.S. government directly. And so there's a risk premium associated with that. Borrowers or lenders who are lending in the form of buying these mortgage-backed securities know that there's risk associated with that. And the more volatile an economy is, the more challenging an economy is, the greater those risks are, the greater potential for loss. And so there's going to be a premium. The other thing that volatility does, you know, beyond just the hedging cost, you know, when you have volatile interest rates, it increases hedging. The other thing volatility does, it increases the premium that investors in these mortgage-backed securities are going to charge, is because, you know, when you invest in a mortgage-backed security, what can happen there is, if, let's say that right now our interest rates are in the high 6s, low 7s, and you invest in mortgage-backed securities that are backed by those high 6s and low 7s, and that's your return on investment. But what happens next year when interest rates go down? Those people in that mortgage-backed security start to refinance, and your return on that mortgage-backed security is tied to the actual mortgages in that pool. And so the more volatility you have, even over a longer period of time, creates that runoff risk where you think you're investing in something that's going to yield you 7% or 6%, but really those people are paying that down, and when rates go way down, let's say they go down back into the 4s or the 5s next year, a lot of those people are going to refinance out of that. And then that long-term investment that it thought you had at 7% is no longer paying that at all. You're getting that back, and you have to reinvest it at lower rates. That's not true of the treasury bills, but that's what happens. That spread goes up when there's that risk of runoff. And it works in reverse too. Like, what if rates do go down? You know, what if rates go up? Well, now you're stuck. You've made that long-term investment in that bond, but now rates have gone up and you want that money back so that you can invest it in the higher rate environment, but you can't do that. Or you can, but you're paying for the loss of the value of your lower rate mortgage-backed security at the time. So all of that creates a spread between what the 10-year treasury is trading at and what a 30-year fixed rate mortgage is. And right now that spread is extremely higher than it has been historically. As we see the market calm down, and this is going to be a little bit of a chicken and egg thing, because if rates come down, that means more volatility, but as the market calms down and there's less volatility in the market, that premium should come down, that spread should come down back to normal kind of ranges. Hopefully we'll see that. And even if all of the things were equal, bringing that spread back down to normal ranges would significantly lower interest rates.